Top 4 Boom and Crash Spike Trading Strategies that actually work. The boom and crash market changes its pattern every now and then. At times, equally good strategies will give you different results, and some strategies would just stop working at all. Therefore, you need to have more than just one strategy in hand to back you up. In this video, I will share my top 4 trading strategies that I personally use to catch spikes in the boom and crash market. I have used these strategies in different trends and market situations. In order to utilize the strategies in the best possible way, make sure you don't skip any part of the underlying strategy. 1. The 3 smooth moving averages. Honestly, if I have to choose my favorite indicator, I'd definitely pick the moving average indicator. I mean, why shouldn't I? Just like Forex, it works pretty great in the boom and crash market, and sometimes it rejects the price from the exact moving average level, resulting in a huge spike. So, how do you exactly use the moving average indicator to catch a spike or a series of spikes in the boom and crash indices? How do you know when to close and when to hold a position? Over the years, I have tried so many moving averages and have found the best combination to be Massachusetts 21, Massachusetts 50 and MA 200. Apply these 3 smooth moving averages on your boom and crash charts, and here's how you can use them. When the boom pairs are on an uptrend, you can expect spikes from MA 21 in every time frame with stop loss right below the moving average. Similarly, in the crash indices, expect spikes from MA 21 when the pairs are following a downtrend. Though works in smaller time frames as well, moving averages work best in bigger time frames such as H1, H4 and D1. Sometimes, it might not reject the price from the exact moving average level, therefore, you should place your stop loss on a little distance to give room for stop loss hunting. Please note that you should not play rough with your stop loss while trading merely on moving averages. Keep in mind that when the pair doesn't give spike from moving average level, it could mean that there's a strong momentum on the opposite side and it could go for hours without generating any spike. 2. Catch spikes with RSI. Relative Strength Index is yet another great indicator that can be used to catch spikes in the boom and crash indices. To use RSI in an effective way, set your RSI levels in the settings. Read the article given in the description for setting up the RSI indicator. Once you set up the RSI levels, follow this RSI strategy to catch spikes in both boom and crash indices. The level between 20 to 30 will most likely reject the price and results in a spike when the pairs are on an uptrend. In the crash indices, expect rejection from RSI 70 to 80 level when the crash indices are following a downtrend. Please note that do not touch the pairs once the RSI break in level 90, because these pairs could be stubborn at time. You can also use the RSI rejection strategy in bigger time frames such as M30, H1, H4 etc. When the RSI of the boom indices comes down to level 50, 40, 30 or 20, you can attempt for a spike. In the crash indices, the level 50, 60, 70 or 80 rejection in bigger time frames can result in a spike. Yet another RSI trading strategy is RSI divergence strategy. Unlike RSI rejection, the RSI divergence could only be used in bigger time frames such as H1 and H4. RSI divergence is when the price makes higher highs and the RSI makes lower highs, or when the price makes lower highs and the RSI higher highs. I recommend you read my article given in the description on RSI divergence to master the strategy. Whenever you spot an RSI divergence in a boom and crash pair, it is an indication of trend reversal and you can expect a spike or a series of spikes in the pair. 3. Demand and supply zones. In trading, a demand zone is a level where most of the traders are willing to buy the asset, whereas a supply zone is a level where most of the traders are willing to sell the asset. In terms of boom and crash indices, supply and demand zones can be used for medium or long-term positions, and you can expect a series of spikes from the levels. A demand zone is just like a strong support level where the price is most likely to get rejected. Once you make your chart, highlight the demand zone and place your order. Make sure to put a stop loss based on your equity and trading style, preferably some 10 to 20 points below the demand zone. You can use the supply zone in crash indices where the price is expected to fall. Highlight the supply zone and make sure to hold one of the positions to get the most out of your trade. 4. Catch boom and crash spikes using the Ichimoku Cloud indicator. Yet another great trading facilitator, the Ichimoku Cloud indicator automatically detects support and resistance levels on your chart. Simply go to the indicators window and add the Ichimoku Cloud indicator to your chart. The next step is to wait for the price to arrive at an Ichimoku support level, in boom indices, and Ichimoku resistance level, in crash indices. When the price is about to touch the level, attempt for a spike with stop loss right below the support or resistance level. Please note that you should not play rough with stop loss here, especially in bigger timeframes, as rejections normally occur from the exact level. If the support or resistance level is unable to reject the price, there is a chance of a strong price action event that could continue for hours without even a single spike. Pro tip: trade with discipline. Formulating your own strategy for boom and crash. Let's be honest, your own practice and conclusions will far outplay my techniques and strategies. That being said, you should play with the above strategies, use your demo account, to see what works for you and what doesn't. Primarily, you should start with testing each of the above boom and crash strategies and shortlist the ones with accurate results. Once you select the strategies that work for you, apply them all together for best results. Let me explain. For example, in the boom 1000, if the price is approaching towards any moving average and there's also a demand zone near the price, and the RSI is near 50, 30, or 20, that would mean that there's a strong chance of rejection and we can expect a spike. The chance of a spike in the price increases with the number of indications, evidence. Therefore, the more indications we have, the bigger the lot size we should go for. Best of luck for your next pip hunt. If you have any questions regarding the boom and crash indices, you can ask in the comment section.